Good afternoon, guys. It's Saturday, March 26th. My name is Dave Coker, and this is Talking About Finance. And once again, 7 slides, 7 days. Let's see what's happening. As we always do, we start out by looking at the S&P 500 just to see what happened over the prior week. And it finished up about 1.79% this week. Once again, on the back of a 6.16% increase last week, we're starting to erode the losses that we had over the year. We're down only now about 4.7% year to date. The VIX actually traded down to 20.81. The 10-year closed this week at 2.48, so we're seeing interest rates surging in the States. And oil finished this week at 112.72. It's up 49.9, we'll call it 50% year to date. So interest rates are surging, not only in the United States, but perhaps across the G7 or maybe the broader G10. High inflation is driving these increases, and we're likely to see continued rate increases. Many analysts suspect this rate tightening cycle that we're in will run until US rates are roughly 2.5%. We're going to have to see. So, higher rates are going to whack housing. We'll talk more about that a little bit later on. The big question is, how are you going to allocate your assets for higher rates? The 60-40 bond portfolio, 70-30 bond equity portfolio. What are you going to be doing? We're seeing a lot of similarities to 1994. And back then, as rates increased, shares got whacked in a fairly significant way. So we'll have to pay attention to this. Expect more equity market volatility and watch the VIX for buying signals. Once again, we've talked about this before. 19 is the long run average on the VIX. The standard deviation is 8. Plus 2 standard deviations has proven a good time to buy. Anytime the VIX is north of 35, put some capital to work, sit back and wait. You're going to have to sit for about 18 months. And about 90% of the time, if you follow this simple strategy, you'll be up over the horizon. So sit back and wait. Just don't get too worried about stuff that you can't control. Rates are going up. Stocks are likely to get hit. They're very bubbly right now. And just see how it all plays out. We know that there's a fair amount of inflation in the system. And also, something that you guys will know if you've been listening for a while is that I'm fairly frugal. Financial independence doesn't come with spending a lot of money. And I track the household budget. Now, at the bottom, I've got the household budget for 2021. At the top, I got for 2022. We're looking at April. And you can see back in 2021, it cost us $74.60 a year to run the house here. Now it's actually surged up. It's actually gone up to $8,006. So it's increased somewhat over the horizon. And we can see that we're quite a bit more expensive across the board. There's other costs that we got to consider. This is happening all over the place. Now, the key thing to keep in mind, guys, is that this reflects my personal cost of inflation. If you're trying to manage your budget by looking at CPI or RPI, US and UK respectively, it's just not going to work. Why are we seeing this inflation? Well, there is an idea about modern monetary theory that people started talking about 4 years ago, and I denounced it as soon as I heard of it. MMT, as it's called, modern monetary theory, is a fringe school of economics that says we can borrow and spend all the money we want, and we never, ever have to worry about paying it back. And in the US, at least, they've put this into practice. In America, they've actually started to run MMT without discussion of any type. And you can see it here with the Fed's balance sheet. It's actually picked up in a major way. Other things that have been going on, money supply has been expanding in a fairly significant manner. And once again, money supply tracking how much money is out there in circulation in various forms. And we can see there's been huge increases, mostly in the response to the pandemic, but still, the money is out there and it's driving inflation. Now that the Fed is starting to increase rates, they're trying to cut the rate of inflation. We can see risk-free rates across the board are really picking up. So I've got the 1-year, the 5-year, and the 10-year here. And we can see since September 2021, there's been huge increases in the risk-free rate. And once again, guys, keep in mind the relationship of stock prices to treasury rates. If you do a discounted cash flow analysis, once again, the denominator will reflect the risk-free rate. And as the denominator gets larger, if the numerator, cash flows from that stock, remain constant, then the quotient definitely gets smaller. In other words, share prices fall. And we do expect to see that happening at some point. Don't worry about it. You shouldn't be trading, you should be investing. And one of the things that you do when you invest is you buy assets regularly. So just keep buying your assets, just accept that you're going to buy and the price might be lower 6 months from now, it might be lower a year from now. But if you're investing, you don't buy assets for the price in 6 months or 1 year. You buy assets for the price in infinity. That's exactly what I do. I buy and hold. What am I going to sell? Never. Start to think along that way. And when you see prices of stocks drop, you're starting to see a bargain at that point. You can actually pile in. Other things that are going on, in particular in the States. Now, this is really fascinating because we're seeing the end of cheap mortgages, as I call it. Once upon a time, mortgage rates, my God, you could pick up a property in the States and lock in a 30-year mortgage for roughly 2.6% or so. Absolutely incredible how low we could see rates would go. And keep in mind, in America, unlike the UK, when you take out a 30-year mortgage, you know exactly what the mortgage payment's going to be every month, all the way out to that 360th payment. Wild stuff. I don't do debt, but to be honest, if I could do debt like that, I might do debt, right? Because, just to have the security of knowing exactly what your payment's going to be in the future. Not just, 30 years in the future, but 1 year in the future, 3 years in the future, 5 years in the future, 7 years in the future. And in any case, we're starting to see the end to cheap mortgages. And you can see we've gone from roughly 2.6% in December of 2020. We're up to 4.42 now. So once again, we're going to see housing in the States get whacked. And people notice these things. Once again, the bankers, the central bankers and politicians are very good about discounting and talking about how inflation's transitory and inflation only impacts rich people and all this garbage that they've been saying. Well, people notice. And consumer confidence is getting whacked in a major way. And you should pay attention to this. This is one of these anecdotal indicators. We're looking at the University of Michigan Consumer Confidence Index. And every time consumer confidence gets hit, the U.S. enters a recession a year to 18 months later. Are we going to see one now? Well, there is a school of thought that says, yes, we're going to see a recession. And there's another school of thought that says, yes, we're going to see a recession. And it's going to be a very, 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 very nasty recession, considering all the stuff that's going on with inflation now. So once again, just structure your portfolios accordingly. Make sure you've got liquidity and get ready to buy some assets on the cheap. And still, we have to think about what we're going to be doing with our money. And this is off Katie Wood's ARK Invest's research. Now, she boasts about how they're doing research that nobody else does, like nobody else does. I have a lot of time for her. She's very, very fascinating. She's getting a lot of bad press now, or some bad press now, because her stocks have been beaten up in the short term. But she's done really well, and she's made lots of people lots of money. And of course, we know she's a big proponent of Bitcoin. Got this really interesting researcher. Go get their annual report. I took a good read through it. Really fascinating when you look at it. What she's doing here, she's taking a look at what you could use Bitcoin for. She's looking at the market cap of that use case, as she's calling it. And she's thinking how much this would contribute if Bitcoin just captures a certain percentage of this use case, how much it would contribute to the price of Bitcoin. Now, when she goes through everything from remittances to an emerging markets currency economic settlement network, my blog, FinTech Flash News, we're talking about that over the past few days. Nation state treasury, seizure resistant asset, institutional investment, corporate treasury, and digital gold. When you put this all together, she comes up with a market cap, a value, I should say, per Bitcoin of 1.36 million. Have you got Bitcoin, guys? Well. As you know, my name is Dave Coker, and every Friday I buy Bitcoin. I've been doing it for years. Now, guys, don't misconstrue it. I'm not buying one Bitcoin every Friday. I got a DM from somebody like that. No. I buy the same amount in terms of pound sterling of Bitcoin every Friday, and I've been doing that for years. And it's called dollar cost averaging, and please consider it. You don't have to put a lot of money into it, but if her forecasts are going to come true, we're trading at roughly 44,000 today. Well, look at the upside. What do you got to lose? Give it a try. And we have other metrics. Now, this is I can't remember who did this. It came from someone, it's off Twitter, and I can't remember who put it in the channel. There's a bunch of, my friends at Goldman all work in the crypto desk, and they're pretty fascinating group of people to talk to. Well, I shouldn't say all my friends at Goldman, a lot of my friends at Goldman, right, working in the crypto desk. And one of them, she dropped this in, and this guy is doing some on-chain analysis, and he's got his own indicator that takes a look at the supply, the liquid supply, and it oscillates. So we know oscillators they swing between extreme values. And he's actually got some interesting points here. His indicator, whenever it drops down and forms a bottom, we can see that Bitcoin tends to pick up after that. And yes, he's calling it. He's saying that we hit just this month, we hit, or actually over the last couple months, so February to March, we hit a bottom, and he's saying the market has recalibrated, and he's predicting that we're going to be moving higher. Once again, I don't really buy for that purpose. I just buy because I know in the future, Bitcoin will be priced higher than it is now. That's why I buy today. This is why I buy every week. And that strategy, I'm not going to say how many years, but for a long time, that strategy has actually worked out pretty well for me. So you might want to start to think about this a little bit. We're always going to have Bitcoin. It looks like it's not going anyplace. Although, the Fed, or the government rather in the States, they're starting to pass some regulations, which I view as a positive. But look at it this way, guys. They could have just tried to outlaw it totally. And whether that would have been successful or not, it would have damaged the price of Bitcoin. They didn't. They're going to regulate and tax it. And it's especially that last part of the decision, tax it. They never will get rid of Bitcoin at this point. Once they can tax it, once they realize a revenue stream from it, they'll regulate it. And it becomes a bona fide mainstream current asset, as it should be. All right, guys, that's it for this week. Once again, keep the faith. Stay optimistic, stay positive, lots of good stuff going on. You're going to make plenty of money if you're positioned well. As you know, I like Bitcoin, I like gold, I like silver, I like dividend-paying stocks, I like rental property. This is the stuff I like. I like high-yield assets. This is the stuff I like. You might want to like it too. Take care, guys.